Hey traders, this is Blake Morrow with Traders Summit, and with me today I have the one and only Giles Coghlan of HYCM. Good to have you again today.
Oh, it's great to be here, Blake. Really looking forward to our session after last time, so I can't wait to get stuck in.
Well, speaking of after last time, I have to commend you. You know, the trade that you really harped on, and you're like, this is it. You guys have to pay attention to the sterling yen, the guppy. It ripped out of this world. So I have to say, great call. So, you know, but you're only as good as your last trade. So right now, I think you're really good. So let's hear what you have to cover today. I want to hear some of thoughts or ideas of how you feel about the market. Do you still feel that the yen is going to be weak moving forward? And how do you feel about the markets in general?
Yeah, so I did set a high bar last time, and I was helped a lot by that yen weakness. Now, there is a seasonal pattern for yen weakness, so it wasn't a massive surprise to see the yen weakness come into the market, but it was a surprise at the extent of it. And that was when traders suddenly looked around the world and they suddenly saw, hang on, Bank of England may be raising interest rates, Reserve Bank of New Zealand, is the Fed going to be having to raise interest rates? All those moves in SONIA futures, and everyone looked at the Bank of Japan and said, well, they may be increasing quantitative easing. They won't be budging for ages. And so everyone just saw, hey, this is a great opportunity. Asset managers, leverage funds. We saw all those yen shorts come into the market. And I see absolutely no reason why they're suddenly going to disappear at all. And there's very good reason for that yen weakness to carry on. And I do have another yen pair that I think is worth looking at. So there is another yen pair that I have to share with us.
Well, let's see it. And, you know, your ideas about continued yen weakness, we, you know, for those of us like yourself that we're old enough to remember the old, you know, yen carry trades, it seems like those might be coming back in vogue again, right?
Yeah, exactly. That's the hope, isn't it? That's the dream. They are back in play.
And all right. Well, let's see what you're looking at.
Yeah, sure. Let me just, shall I share my screen here, Blake?
Absolutely. Please do.
Share that now. Right. So that should be coming across. Now, first of all, that pound yen, just briefly run through that, because that was just a really good example of the technicals and the fundamentals coming together. We could suddenly see that there was very good reasons for the pound to be finding buyers on expectations that the Bank of England would be raising interest rates to control inflation. So there was a strong bias for pound upside. The yen, there was no indication at all that the Bank of Japan would be shifting interest rates. We're a very simple yield differential. And then we saw a beautiful hidden bullish divergence with price making higher lows and the indicator making lower highs. Now, sometimes I get in trouble for doing one of these hidden bullish diversions that isn't quite technically perfect, but this one was. So even the technicians would not be on my back for this one. And we just took that very simple trendline break on the daily and the weekly and just taking profit up at those highs. Very nice little move to the upside. Wouldn't be surprised to see pound yen still going. Remember, the Bank of England did surprise markets by rolling back expectations of interest rate hikes, but they're still expecting to raise interest rates to 1% by the end of 2022. So I think there still is reasonable expectations of pound yen upside. But for me, there is a better opportunity with the yen pairs, and that is with the New Zealand dollar Japanese yen pair. Now, when this was breaking higher on that yen weakness, this was a pair I was looking to enter. And the area that I saw to obviously enter was simply on a retracement back to this 80-20 region. Now, I have been filled overnight, and that fill has been pretty much perfect because that was just the near-term resistance turn support, the logical level where we'll see people entering. Now, the rationale for the trade, again, is very similar. Now, the Reserve Bank of New Zealand has to grapple with two things. One, 10-year high inflation, and two, unemployment is down to some of its lowest levels in about 14 years. So that's increasing expectations from the investment banks Westpac and ANZ that the RBNZ are going to have to raise interest rates to cool the economy. And I think Westpac was seeing a 3% interest rate hike by 2023 for the RBNZ. And we're increasing expectations now of a 50 basis point rate hike on the November 24th meeting. So looking into that 24th meeting, it's reasonable to expect more New Zealand dollar upside. Now, the Japanese yen should remain weak because the yield differentials between the New Zealand 10 years and the Japanese 10 years are really suiting more New Zealand dollar yen upside, as investors are not expecting any significant rate shifts from the Bank of Japan at all. And you can see here, I've got the 10-year bond yield differential from the New Zealand 10-year and the Japanese 10-year bond yield. And you can just see that that yield is still pushing to the upside, price moving a little bit lower. So anticipating price at the very least to move back up to that 82 region. And actually I'm looking for more, and I'm looking for that to be rocketing up into that RBNZ meeting around November the 24th. So my near-term risk is here. I think if this rotates lower, I would exit around that 79.50 region. And then I would look at either a deeper retracement back down to that 78.50 to consider longs, or I would simply look at a trend line break to the upside. So the way I'd manage this, and in fact, someone was just chatting with me today saying, you know, I missed 80.20. Is it too late to get in? Now, my general rule of thumb is, you know, if you didn't have the conviction to put your buy limit order in 80.20, don't jump in now, because you're not going to have the conviction. You know, you weren't really fully committed, and then you're going to be exiting and, you know, entering as the wind blows. So I said, don't chase it. But what little strategy you can do, and it's helpful, is if you think you've missed the trade, you can always go with a trend line break to the upside. So this was just something I put in earlier, you know, a few hours ago. Just a simple trend line break is another way of entering, and go with the trend line break, because you can very easily define and limit your risk just below the trend line. And if you move back below the trend line, you can exit with a relatively small loss. I find it a very successful strategy, particularly when you're not quite sure how deep that pullback's going to be, and you don't want to be having 300, 400 point stop. Because that's the danger with a trade like this is, you know, where do you put your stop? Well, your stop has to be underneath the 200 exponential moving average, in my book, before you're considered wrong. But that is a 400 point stop, and that is deeply unpleasant to have anywhere near that kind of drawdown. So what I like to do is take little chunks. This is the obvious place to just have a first nibble. And then if that capitulates, exit the trade. You can always re-enter with a break to the upside, rather than thinking, oh, I'm 300 points down, and then the RBNZ decides to turn dovish on me on November the 24th, and then, you know, you're underwater. And that's the way that trading goes. So that's the pair that I really like, and I think it's definitely worth considering. First test at 82, and I'm looking for further than 82. So that's my rationale for the New Zealand dollar yen.
I love the setup. You know, this is a really basic technical analysis. Great setup as far as breakout, previous resistance, turn support. Yeah. You probably got a couple fib levels really close. And you approach it just like any trader should. Just having a good risk reward at any moment in time. Excuse me, really quick. Sorry about that. Having a good risk reward at any moment in time. That's the key when we're trading the markets. You know, you and I just before we hit the record button for this interview, we were discussing gold a little bit, and gold's actually made quite a bit of a move today following the inflation data. Do you want to talk a little bit about gold as we wrap things up?
Yeah, I'd love to. I've been really talking about gold a lot to the groups that I've been running. And one of the great things about gold is we're entering quite a strong seasonal time of year. Now, you obviously get that strong physical demand for gold around the Chinese Lunar New Year. So it tends to result in some disproportionate gains for gold over the sort of from this period on into February next year. Now, the real red hot period is like December the 20th through to about the end of Feb, but this is still pretty warm. So this was in the back of my mind about gold. We're heading into that hot period. You can see, it's gained 17 times in 25 years at a sort of 70% winning trade ratio. So there is a disposition for gold to rise here. I use a great product called Seasonax by the way, which analyzes all sorts of seasonal trends. Very good. And the thing that got me in gold was seeing this real yields drop, Blake. I was watching these real yields drop lower. And as real yields drop lower, we know that's a good upside for gold, particularly when the dollar's playing ball as well. When the dollar's dropping and real yields are dropping, that's when we get those great opportunities. So just over the last sort of week, I just saw the real yields falling. And I saw that after the last Fed meeting, the market was much more patient about the Fed's prospect of raising interest rates. The Fed were showing that they're going to have a patient, flexible stance. So I was speaking to Yahoo Finance as the news broke, and I thought, yeah, the Fed's done the right thing. They're being flexible. Now that was perfect for gold upside. So when I realized that that was all coming together, then it was just a simple question of a very simple trend line break on gold. And I took a very simple, now, technically, is that a trend line? Now, the purists would say, no, it isn't, because you need 3 touches. That is a potential trend line. But because the fundamental story was so positive for gold, I knew that that trend line would become the reference point, even though technically it's not perfect. It was good enough. And then I was long gold just before the NFP, and the NFP was a good strong print on Friday. You can see that candle there. We see gold moving down as the snap reaction was, good jobs. Fed can, economic policy goes to the forefront. Then everyone realized, oh, hang on, that's not going to change the Fed's mind, is it?
Yeah.
And gold rallied. And, I was just long gold, thinking, okay, let's see how this plays out, hoping for a weak NFP report. Saw the report and then was pleasantly surprised, market looking through it. Great. So I held on to my longs, moving up through here. And then I thought, I know what's going to happen today with the CPI print. It's asymmetric risk once again. If CPI is high, we could expect a small dip lower, and then we could expect buyers on the dip. Exactly with the same narrative on Friday. Is the Fed on? Yes, it's great jobs, but the Fed won't budge. Yes, it's high inflation, but the Fed won't budge. So that's been the narrative. So now with gold moving up into 1860, we were talking about this before, sensible place to take profit. So I've taken half a clip off there on those 1860. Want to keep the rest for the home run. Maybe I'll get it, maybe I won't. But those strong seasonals, just worth looking how they run. Like if I can get through to December, you'll see how exciting gold is from there. Now, if you look at gold from the end of December, excellent, 4.31% return. And if you look at this over the last sort of 10 years, you can see how disproportionate it is to the upside. COVID-19 restrictions should ease. China should be celebrating the Lunar New Year. Isn't it great? All that pent-up savings. You can buy mum and dad a bigger golden bowl to make up for the golden bowl that you didn't purchase them last year. So that's my hope, Blake. Whether it happens or not, I don't know. But I'll be monitoring the Fed's policy. My one fear with this outlook for gold is that inflation runs so hot that the market says to the Fed, you've got it wrong. You've been too patient. It's not transitory. It's a problem. And the high inflation will force their hand. And because inflation was so high today, pushing up over 6%, that was enough to get me concerned that other people might be concerned about that. And that may move the Fed to move more quickly in an emergency measure. So that is the not insignificant risk to gold upside and current Fed policy. But I have to be acknowledged that because I got skin in the game, you don't necessarily see things as coolly as when you haven't got a position on, and it always skews your pitch. So I've got my analyst head and my trading head competing with each other there.
We kind of like those two on each shoulder, I'm sure. Yeah. So, well, Giles, it's always enlightening to speak with you, and I love your views on the markets. I love your not only macro approach, but your technical approach and prowess to the market, and always thinking about your risk versus reward, which is so dire and is so important to the trading community. So, Giles, I want to say thank you so much. And guys and gals, you're listening to Giles and you want to see more of him, make sure you click thumbs up. You're giving him a thumbs up, telling him what a great job he's doing. Subscribe to the channel. It's free to do so you don't miss any content from Giles. And Giles, how do I find out more about you? If I'm a trader at home, I want to find out about you. Where do I go?
Yeah, well, you can go along to my Twitter page. I've got a Twitter page, and my Twitter handle is @Giles CCA. So that's one way of finding out about me. And I also have a LinkedIn profile. So on my LinkedIn profile, you can also find out about me there, giles.coghlan on LinkedIn. And I'm always happy to connect with traders and provide, any guidance that I can.
Well, Giles, thank you so much for another great interview and spending your time with us. I know I appreciate it. I know the traders at home appreciate it. And we'll try to connect towards the end of the year so we can get your 2022 views. How's that sound?
Oh, that sounds perfect, Blake. I look forward to it already.
Same here. Thanks for joining us today.
Thanks, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.